Legendary investor Ray Dalio recently shared why he believes the stock market today is in a growing bubble. Why? Well, it relates to inflation, but not the typical kind that you might be thinking of. Not when you go to the store and it costs more to buy groceries. There is a different kind of inflation that Ray Dalio fears. So, in this video, we're going to hear why Dalio is fearful, why he thinks the market is a bubble, and I'll break down exactly what this means for us investors. Hi and welcome back. My name is Tom Heavey. I hope you're doing well. So I'm not going to make you wait. Instead, let's just jump straight into this first clip with Ray.
There are different kinds of inflation. I'm not particularly worried about the classic supply, demand pressing up against supply, although we'll find out soon because there's something like 10% of GDP stored in financial assets that's going to be coming out. And so it's likely that there's going to be a big pickup in demand, and that will probably raise prices significantly. And it also depends how you count for inflation, because like housing prices themselves are going up a lot, but rental prices are going down a lot. The big things I think are, and if you went to a 3% inflation rate or some bounce, that's not one of those things that gets me very nervous or very excited. The real issue is that we have a supply-demand issue of bonds, because we're going to have to sell a lot of bonds to those in the world who own bond inventories. And they have very low interest rates, negative real interest rates, and they're overweighted in U.S. bonds, and they're going to have to buy a lot more. And that is also coming at a time when Chinese capital markets, other capital markets are becoming more attractive. That creates a supply-demand issue that can create a monetary inflation, because there will not be enough demand to buy those bonds. And that means that it's likely that the Federal Reserve will not be able to taper or cut back, and might actually have to increase to prevent interest rates from going up. And that's a classic monetary inflation. So that's my bigger concern than just the spurt. I think for most of the world, the real question is, what are interest rates relative to inflation, and also what is happening with all this liquidity, because there's a huge amount of liquidity and negative real interest rates. And that means that it pays not to own any debt instruments. It pays not to own cash, certainly not cash, where you get no interest rate in an environment, like Larry says, of some amount of significant inflation. I think it'll be, let's say, in the vicinity of over 3%. So you get taxed at that rate in terms of buying power. And so when I look at that, I think you're going to see the continued inflation in other assets, and it pays to borrow a lot. I know, to borrow houses right now, to buy, I'm seeing interest-only loans being made when there's basically no interest rate. In other words, you don't have to pay back your principal anytime soon. And the interest rates are so low, so there's a lot of money being thrown around that way. Those are the things that concern me more, because you build up a bubble. You saw the reaction in the markets when the Fed just even hinted at tightening. I don't think they can tighten a lot without having a big negative effect. So that's what it looks like to me, the whole picture of the low real interest rates, and then also the worries about the supply-demand monetary inflation, and also the Fed tightening. I'm more worried about the inflation in financial assets and what that means for returns and bubbles that are developing, because there's a massive amount of liquidity around, and it's being thrown around so that it's a difficult environment for those returns to be justified. I think we're building kind of a bubble. So I think inflation in financial assets and so on is an issue related to liquidity. Anyway, you think about it, what's happened is the net worth of Americans, and most people in developed countries, is higher than it's ever been. All of a sudden, it was a big boost to net income, but yet production isn't. So what you've seen is a lot of people got a lot of money, which they're still holding, and they put it into the stock market and everything, and interest rates go down and they borrow. And that is a dynamic that creates a bubble. And that's what I would say is the main issue.
So if you've been investing in the stock market for any period of time and following the news, no doubt you'll have seen that most investors are screaming today about their fears of inflation. Why exactly would inflation be bad for the market? Well, when inflation begins to rise, the Fed's response is usually to raise interest rates. When they do that, it changes discount rate calculations for the stock market, and if all else is equal, it will mean the stock market is going to fall in value. But here's the thing. Dalio is not worried about traditional inflation. He's not worried if house prices are going up or if it costs you more to buy a pint of milk at the store. He's worried about inflation specifically in the price of financial assets. And if we want to narrow in even further, we're talking about America's bond market. You see, in order to raise money, the US government, like every government worldwide, will sell bonds. This is essentially them asking to be loaned money in return for an interest rate. Then they can use this money, along with the income they receive from tax, to carry out government spending. So it's absolutely essential that the US government are able to sell their bonds. And as Dalio describes it, when you look at the world and see who holds America's bonds today and what their incentives are, he believes that those major investors are likely to sell American bonds in the coming months and years going forwards. This would cause interest rates to rise, which could have a major impact on the American economy and stock market. But of course, the Fed can't allow this to happen. So what's the solution? Well, their only viable solution is to become the buyer of those bonds themselves. If someone else sells an American bond, then the Fed buys it. At least they're balancing things out. The problem there, though, is that the Fed only gets the money to buy these bonds in the first place by printing more money. Now, not exactly surprisingly, printing so much money is exactly why people are worried about inflation in the first place. So the Fed are basically stuck between a rock and a hard place. If they don't print money, they risk America's bond market being affected, which would in turn damage the economy. If they do print more money though, they continue to inflate the supply of cash and spark even more fears of inflation. So, which path will they choose? Well, the way Dalio sees it, they will have to buy those bonds, which means they have to print more money, and so the fears of inflation rising will continue. Now we're going to hear Dalio's thoughts on the US dollar and why he believes it may struggle versus other currencies.
You mentioned the dollar. I mean, I guess one could see there are different scenarios that come out of this. I mean, the classic scenario for the US growing faster than everybody else, sucking in a lot of imports, would be that actually the dollar could rise and export problems to the rest of the world that way. But Ray, you just mentioned that you potentially see the dollar heading down. So is there a fundamental threat to the dollar that comes out of this?
Yes. I'm just dealing with the mechanics. The way it works is you sell a lot of bonds. So now who do you sell the bonds to? And then when I look around and calculate who owns the bonds and what they have to buy and what the incentives of buying, they're bad. And in fact, you could see dollar selling of bonds. What that means is then the Federal Reserve is in a position of either seeing rates rise because there's not enough demand to meet that. In fact, if they start selling, it would be a very bad situation. And that they can't let that happen because that would be very bad for the economy and markets and all sorts of things. So we have to keep in mind where we are. We're at the end of a long-term debt cycle. And that means that the Federal Reserve will have to do what they did last time, which is to buy a lot more to prevent the interest rates from going up. That's very non-cyclical. It's one of those cases where, in reserve currencies, it's a very dangerous thing. Now you compare that with alternatives. First, the best alternatives are other asset classes, but also let's say China, for example. I think the situation that we're in is quite similar to the going from the late 60s into the early 70s when there was a different core inflation rate in the United States versus Germany and Japan. It's a different balance of payments situation. We're in basically a balance of payments deficit. They're in a balance of payments surplus position. That means that they chronologically are worried about imported inflation, and there's favorable capital flows. So I think that that's negative for the dollar, particularly against Asian currencies.
So while there is some logic to say that the US dollar could get stronger in the coming months as the US economy grows versus other countries, Dalio sits on the other side of the fence. He believes that the US printing so much money to buy more bonds will ultimately cause the dollar to fall in value in relation to other currencies. Now, I do want to make something really clear. Just because Ray Dalio thinks inflation is inevitable, it doesn't mean he's right. In recent videos, I've featured Cathie Wood sharing her thoughts on why she thinks deflation is coming. Not inflation, deflation. She thinks the exact opposite of Dalio and is preparing for a very different outcome. Now, the reason I'm featuring Dalio today is because as investors, it's important that we hear both sides of every story. Otherwise, we'll never develop a truly balanced perspective. Now, I'm interested to know what you think. Do you think inflation is coming, or do you think deflation is the bigger threat? Let me know your thoughts in the comments below. Thank you for watching, and I will see you again very soon.